What's up guys, welcome back, I'm Mike.
And I'm Brit. And about a month ago we made a video about how we were able to save up $100,000 in 2 years.
And then just last week we made another video explaining how we invested a large chunk of that money into the stock market. However, we didn't really go into the details or specifics about how we invested it.
Because that's what we wanted to do today. Today we're going to be going over all 4 of our investment portfolios, what we're invested in, how much we've invested, and why. But before we get into that, we wanted to mention a few things.
The first being that investing can be very personal. Depending on your goals, your risk tolerance, what stage of life you're in, that can determine a lot about what your portfolio actually looks like. And in Brittany's and my case, that's determined a lot about what our portfolios look like. Not only that, but the investing world can get very deep very quickly. You've got a ton of variables involved, different investment vehicles to explore, a lot of nuances, risk versus reward analysis, technical analysis, company research, financial statements to look over, and the list goes on and on and on and on. Even though we've researched each and every one of those things with the companies and ETFs we're invested in, we don't really plan on going into any of that much in this video, or else we'd be here for the next 2 or 3 hours.
Yeah. Our intention with this video is to keep things very surface level and to provide a general understanding of our thought process and goals with what we are invested in.
So if you enjoy videos like this or appreciate the transparency, go ahead and hit that like button for us. It helps out our channel tremendously and also helps YouTube promote our videos to other people.
Like we mentioned before, we have 4 portfolios that we've created, and the first one is my Roth IRA, the second one is Mike's Roth IRA, the third is a dividend-focused portfolio, and the last one is focused more on growth with a little bit of speculation.
Within all of these portfolios, we're really only investing in 2 types of things. One is ETFs, and if you're not familiar with ETFs, that stands for exchange traded funds, and what those are, they're basically index funds that you can buy and sell on the open stock market. The second thing we're investing in is just stocks, so just individual companies.
So first, let's talk about our Roth IRAs. And our main goal with this was something we could fund and forget about. And if all else fails with the other investment portfolios we have, it's something we can fall back on.
So with these, we're invested in ETFs, and that's it. We don't have any individual stocks in our Roth IRAs, and that's just because, like Brittany said, it's just we want to fund them and forget about them. We want these to be very passive. Other people are going to manage them for us. We want these, in general, just to track what the market is doing as a whole. However, we have slanted our positions in our Roth IRAs toward growth and information technology, as you'll see in a second. Our first holding is the Vanguard Total Stock Market Index Fund ETF. I know it's a very long phrase, but the ticker symbol for this is just VTI. And if you're invested in the index fund equivalent, you may be invested in VT-SAX or VTSMX. Those are pretty much the index fund version of this ETF, or this ETF is the ETF of those index funds. VTI makes up 50% of Brittany's and my Roth IRAs. And as the title of the fund is called, this just tracks the market as a whole. So whatever the market is doing as a whole, that's the goal of this ETF. It just wants to track that. So if the market as a whole is up, VTI is up. If the market as a whole is down, VTI is down. Total, between both Brittany and I, we have a little over 60 shares, 60.4234 shares. And that those 0.4234 shares are just basically from dividends that we get paid that are just automatically reinvested back into VTI. Our dollar amount in this is $13,775.93. The next holding that we have is an ETF called VUG, or the Vanguard Growth Index Fund ETF. This is comprised of growth companies that are, I guess, expected to grow more quickly than typical blue chip, strong dividend paying companies like that. This represents 25% of our Roth IRAs. We have in total a little over 22 shares, 22.0765 shares, and this makes up $6,557.16 of our portfolios combined, or our Roth IRA portfolios combined. The third and last holding that we have is the Vanguard Information Technology ETF, VGT. This is an ETF that is focused, as the title says, just on information technology. I am very bullish on information technology over the next 30, 40, 50 years. So my expectation is that this particular holding is going to perform very well for us over the next few decades, at least I hope. This makes up the last 25% of Brittany's and my portfolios. We have 18.0522 shares between the 2 of us, which comes out to be $7,464.22. In total, for both of our Roth IRAs, $27,797.31. All right, so those are our first 2 portfolios that we're going to go over in this video. Our third portfolio is what we call our dividend portfolio.
And our main goals with this was to have something we could create passive income from that would have long-term growth potential and wouldn't have too much risk.
So dividends, if you're not familiar, are basically capital that a company takes from its cash stores and pays out to its shareholders every month or quarter or yearly or whatever. This is a great way to build passive income. So the majority of our holdings for this portfolio are just great companies with great balance sheets that pay dividends, whether small dividends or large dividends. There are a small number of companies or funds that have a much higher dividend payout that we kind of see as maybe a little bit riskier. However, we wouldn't be investing in them if we didn't see good growth potential. We're not funding our dividend portfolio nearly as aggressively as we are our growth portfolio, which we'll go over after this. That's just because with dividends, there's like an extra tax liability that typically comes with that, unless you get paid dividends in your Roth IRA. This is not a Roth IRA.
Yeah.
So we just don't want the extra tax liability.
And the first company we're invested in is Ally Bank, and its ticker symbol is ALLY. This is actually a bank we've been using for a while now, and we've been enjoying it. It has great customer service and great products.
This is where we have our emergency fund. We haven't had to use their customer service all that much, but the few times we had, it's been a very pleasant experience. Their balance sheet isn't the best that I've seen, but it's not bad either. So we invested a little bit of money into Ally just because we like them so much. So we have 20.0354 shares, which comes out to $1,021.20. Our next holding is Apple, and I'm sure everybody watching is familiar with Apple, so we're not going to talk about Apple very much, but Apple has the strongest balance sheet I've ever seen in the year or so that I've been looking at balance sheets. They continually crush earnings. They have a ton of money in cash just sitting on the sidelines. Not only that, they're just a cash machine. Their revenues are crazy. There's rumors of them making their own car. I'm not sure how reliable these rumors are, but I've heard whispers, so to speak, of Apple maybe making their own car. Brit and I have, in our dividend portfolio, we have 70.0174 shares, which comes out to $10,317.76 in Apple. Microsoft is the next one on this. Is another one that I'm sure everybody who's watching is familiar with. They also have a great balance sheet. Their CEO, I feel like, is doing an incredible job leading the company. Their returns over the past 10 years have just been insane. Like if you compare Microsoft to the S&P 500 over like the last, basically over Microsoft's lifetime. I mean, Microsoft's like way up here while the S&P 500 is like way down here. It's crazy. We have 38.0239 shares in our dividend portfolio, which is about $10,917.42. And
the next company we're invested in is ONEOK, and this is a natural gas and energy company based out of Tulsa, Oklahoma. It's not necessarily a company we would buy now, but we first bought into this company at the bottom of the market in 2020 and wish we had actually bought more during that time.
It's performed very well for us. We have more than doubled our money. We don't have any shares. We have 10 shares, which comes out to be $514.30. Next one is Store Capital. So Store Capital is what's called a REIT, R-E-I-T, which stands for Real Estate Investment Trust. Brittany and I like real estate, but we don't necessarily want to be landlords or hire a management company to own or to manage a bunch of properties for us. So the next best thing in our minds is just to invest in REITs in the stock market. REITs give us a little bit of exposure to real estate in the stock market. We don't have many shares of Store Capital. They're pretty stable. They haven't performed the best, especially not during the shutdowns last year. We have one share. They're not a bad REIT, but we probably will sell out of our one share. I kind of just bought this just to kind of track, and so I could see it. This is another one we bought at the bottom of the market in 2020. So most of our money here is profit, $35.93. But again, we probably will sell this one just because I don't think we want to continue holding it. Okay, the next one we're going to talk about was actually a mistake. We should not have bought into this company.
Yeah.
The next one is Sony, and don't get me wrong, I'm not saying Sony is a bad company.
We actually love their products.
Yeah, we're using a Sony camera. I've got another Sony camera that I use for photography all the time. I didn't do enough research into the fundamentals of this company before investing into them. They don't even pay dividends right now. I think they may have in the past, but they don't right now. So this company doesn't even belong in this portfolio. Their balance sheet isn't exactly what we're looking for. Not a bad company, just not
for us.
Yeah, just not for us right now. So we have 5 shares that we will probably be selling soon. We're a little bit underwater. We're like $30 underwater on this holding for a total of $518.40.
The next thing we're invested in is Jeppy, which sounds like it should be a brand of peanut butter, like Jiffy, and it is JP Morgan Equity Premium Income ETF.
So this one is actually actively managed. This fund has probably the highest expense ratio out of all the funds we're invested in. I think its expense ratio is like 0.35 or 0.4%. It's been worth it so far because we're getting a little over 1% return every month in terms of growth, plus like a 7.5% dividend payout. So this fund, in my opinion, has been killing it so far. We have 37.2459 shares, which is about $2,299.56. The next ETF we've invested in our dividend-paying portfolio is SCHD, which is Charles Schwab U.S. Dividend Equity ETF. So, and again, just as a reminder, the ETFs are they're like index funds. They hold a bunch of companies within them. By investing in ETFs, we were kind of investing in a lot of companies all at once. But this particular one, SCHD, is in my opinion, a great mix between dividend payouts and growth potential. They have solid blue chip companies within them. For example, like their top 3 holdings, I think, are Merck, which is like a medical company, Home Depot, and Texas Instruments. So very, very strong. These companies have been around a while. Very strong track records in terms of growth and dividend payouts. We have 60.3572 shares, which comes out to $4,639.66, which leads us into our last holding in our dividend portfolio, and that is VFH. This is a financial sector ETF. So this is the Vanguard Financials ETF. It has companies like JP Morgan and a bunch of other financial companies. We didn't want to invest directly in any more financial companies because we already have Ally. We may invest in other banks in the future, but for right now, we wanted exposure to the financial market, but we didn't want to invest in any more individual companies. With VFH, we have 20.0607 shares for a total of $1,823.92.
So with all that out of the way, the grand total for our dividend portfolio is $32,088.15.
So you may also be wondering, okay, well, since this is a dividend portfolio or passive income portfolio, how much passive income does this generate? So all of our portfolios generate a little bit of passive income. This generates a lot more than the rest of them. This one generates $558.27 per year. That number is actually going to go up year over year because we're going to keep investing in this account, but also because all the dividends we're getting paid, we're just reinvesting back into the companies that pay them. So this portfolio isn't complete yet. We still want to grow these positions out a little bit more. We want to get a little bit more exposure to other REITs than Store Capital. We may want to invest in Realty Income and Stag Industrial. So I need to research those two things a little bit more. But yeah, that's our dividend portfolio.
Our fourth and final portfolio is our growth and speculative portfolio. And our main goal with this was to have a higher reward potential, but the trade-off, however, with this is there's higher risk involved.
So in this portfolio, there are almost no dividends. I think maybe a couple companies that we have in here pay dividends, but their dividend payout is very low. Our plans for this portfolio, we haven't finished funding it yet. Our plans are the vast majority of our holdings in here, we want to be just solid, strong companies, great track record, great growth potential going into the future, and maybe 10 to 15, maybe 20% at the most is speculative, just speculation, meaning we're investing in companies with like a smaller market cap that are maybe newer, maybe have great balance sheets, but just, Wall Street hasn't recognized them yet, hasn't bought into these yet. So our first holding in our growth portfolio is Google, which you guys are probably familiar with. So they're big on advertising. They own YouTube. They get a ton of money. They just crushed earnings recently. I think they had earnings last week. They crushed earnings they just blew earnings out of the park. Their CEO is doing a very good job, in my opinion. We have 6 shares of Google, which comes out to $16,275.60. The next company is Amazon, which I'm sure everybody is familiar with. Like we said, we're investing in very good companies, strong track records, great balance sheets. They have a decent amount of cash on hand. Not only do they do, the Amazon.com stuff with, buying and selling that everybody's familiar with, they also have a web hosting service, which is abbreviated AWS, Amazon Web Hosting Service, I think. And that's growing in revenue exponentially right now. We have 3 shares of Amazon, which comes out to $10,098.22.
And the next one is Apple, and we've already gone over that.
Yep.
So in this portfolio, we have 20 shares, which comes out to $2,947.20.
All right, and the next one is Facebook. I think when most people think about Facebook, they think of the social media platform that is Facebook, that came out like when Brittany and I were in college.
Yeah.
And was just meant to connect people who were in college, who used to be in high school together, but just meant to find your friends. And now it's grown into this huge thing. When people think about Facebook, what I don't think they think of, however, is Instagram and WhatsApp and a bunch of other of these very smaller social media platforms that Facebook also owns.
Yeah.
They also own Oculus. which is like, a virtual reality type of thing, which is something that Facebook's getting into. They're getting into AR and VR, which I think is very fascinating. So we have 6 shares of Facebook. This comes out to be $2,107.44.
And the next one is Microsoft, and we mentioned that before as well. In this portfolio, we have 7 shares, and it totals $2,009.84.
And the last of our regular holdings in our growth portfolio is NVIDIA. Some of you guys may be familiar with NVIDIA, some of you may not be. NVIDIA is like a graphics card chip producer. So, you have computer processors, CPUs, there's also graphics processors or GPUs. NVIDIA has to do with the graphics processors. They make very, very good graphics processors. Graphics processors, if you guys have been following cryptocurrency, are used a lot more than CPUs are to mine cryptocurrency. I don't even know if you can use CPUs anymore to mine cryptocurrency, but there's this whole thing about using graphics card to mine cryptocurrency these days.
As you've seen with the recent skyrocketing in prices for graphics cards.
Yeah, if you guys are into building computers or whatever, you probably noticed that. So NVIDIA is also into the AI space, artificial intelligence. I think that's where a decent amount of their growth is going to come from in the future as well, alongside these graphics chips. We have 11 shares, and that's after the stock split. 11 shares totaling $2,179.65. All right, guys, so now we're going to be moving on from the very solid companies into the more speculative area of our growth portfolio. The first company we're going to mention that we're invested in, this more speculative, is Coinbase. This has to do with cryptocurrency as well. So Coinbase is one of the largest crypto brokerages in existence right now. It's not the largest. I think it may be the second largest. I'm not sure. You guys can let me know in the comments. I've got a very positive outlook for their future. It's kind of like what Warren Buffett said. Coinbase exists in this crypto brokerage market. There's probably going to be other companies popping up. We're going to mention another company here shortly that we're invested in the crypto market. But who knows who's going to win? There's going to be a bunch of companies that kind of sprout up. It's anybody's guess as to who wins. But I think Coinbase is a solid play. Their balance sheet looks good. They make a ton of cash. Their margins are incredible. So we bought 7 shares of Coinbase so far for a total of $1,611.26. The next one is Corsair Gaming. This is another kind of like computer or gaming type of play, like maybe NVIDIA was. I think Corsair is a solid company. They just had earnings this morning. They missed earnings a little bit, which kind of tanked the stock price, which is not good for this holding of ours.
No.
But they make great computer hardware. I think their CEO is doing a good job. They make power supplies, memory, keyboards. I think they just came out with a webcam. They also own Elgato streaming software, which is really big in the streaming space. Logitech is their biggest competitor, and Logitech is doing really well. I think Logitech's up like over 600% in the last 5 years. I think eventually Corsair will get to that point. It's just a matter of when will Wall Street catch on to this stock.
Right.
So we have 160 shares of Corsair for a total of $4,340.80.
The next speculative play we have is Palantir, which I'm sure some of you have heard about. It's at the intersection of big data and AI.
This actually used to be a meme stock not too long ago. Unfortunately so, in my opinion. I don't really think it deserves to be a meme stock. We have high hopes for this company. I think this is a popular one in the retail investing space. I'm not sure if these big hedge funds or corporate investing firms have caught on to Palantir yet. I know Cathie Wood has. Cathie Wood's bought up a lot of Palantir. Most of their revenue comes from government contracts. However, they are expanding into the private market, private sector. Their technology, their products are just very fascinating. I kind of feel like what they could do for small business or big business, like once a business signs on to that type of thing, they would have a very difficult time wanting to move away from that. It's very sticky. That's the word I'm looking for. It's like a sticky model. We have 32 shares of Palantir, which comes out to $711.68.
So our last and final speculative play is Voyager Digital.
This is another one that's in the crypto space.
Yeah.
It's a much smaller company than Coinbase is. So I kind of feel like it's going to be a lot easier for Voyager to 10x than Coinbase would be to 10x. I could be wrong though. But Voyager they just have the outright goal of becoming like a mainstream, not just crypto brokerage, but just mainstream brokerage. Like they want to get into securities and buying and selling stocks and things like that. They also want to develop checking and savings accounts for their users. So they just want to be an all-in-one financial stop and shop, or whatever the name would be. I don't know.
Yeah.
The CEO of Voyager used to be the CEO of E-Trade, which is another successful stock platform. I like this company a lot. I'm very bullish about it. We are a decent amount underwater. I think our average price per share right now is like $17 something, around 17 bucks. We have 200 shares, which totals $2,754 even. Okay, so total for our growth and speculative portfolio, $45,036.19. We also have some cash that we've set aside for good deals that we may see in the future. Not much, $4,837.21. So that's part of our portfolio, but we haven't really invested it into anything. It's just sitting as cash. Okay, so the grand total for everything. Our Roth IRAs, we have $27,700 $797.31.
In our dividend portfolio, it's $32,088.15.
Our growth portfolio, we've got $45,036.19.
Last, what Mike just talked about, our cash, which is $4,837.21.
Yep, so all that adds up to $109,758.86. And that's the balance as of Tuesday evening at 6:40 p.m. This is going to change every minute going forward, so it could go up the rest of the week, it could go down, or it could just kind of trade sideways. As of right now, that's how much we have. So thank you so much for watching. We appreciate it. If you enjoyed this video, if you enjoyed the transparency, again, give us a huge thumbs up. It helps out tremendously.
Also, subscribe for more, and you can follow us on Instagram at It's Mike and Brit. We post there every now and then.
Yeah, thanks again, guys. We'll see you next time.
Bye.